Hello students, welcome to all of you Shiksha 360. So today we will discuss the first topic of KYC AML certificate exam by Iibf, that is KYC policy and customer acceptance. Clear, this is a very short video regarding that. So let's discuss regarding that. So first of all, genesis of KYC, practice of introduction. So primary banking business is accepting. What is the primary banking business? Basically, it is accepting the deposits and lending. Hence, knowing a customer has been a fundamental requirement for enabling the banks. Clear? So, hence, knowing a customer has been a fundamental requirement for enabling the banks to conduct their business. With the expansion of banking and introduction of negotiable instruments, clear, with the expansion of banking and the introduction of negotiable instruments, the practice of obtaining the introduction before accepting a person as customer was formalized. Clear? So, like we are doing the business of deposit and lending. Clear? So, first of all, we are as a banker, basically that they have to know regarding the person. So the practice or this practice became the basis for establishing a banker-customer relationship. Earlier, though, introduction was not mandatory for opening a bank account. So there would be certain restrictions on such accounts, especially no check facility would be given. Okay. So for borrowers, banks have always conducted due diligence with the view to mitigating the credit risk. Clear, that is to reduce the failure of the loan. Clear, to mitigate, that is to reduce the credit risk. Clear, like if the bank is lending to someone, so basically they have to check the history of that person. Clear, whether that person is able to repay the loan or not. Proposition of customer due diligence. Clear, proposition of customer due diligence. As the abuse of banks by money launderers gained significant proportions, various international agencies that were engaged in studying this menace recommended that the banks and financial institutions, clear, that the banks and financial institutions should carry out customer due diligence before undertaking any transaction for them. Clear, should take that the banks and financial institutions should carry out customer due diligence. Clear, in some places you will read this word as CDD, customer due diligence. So thus a due diligence that was found useful for assessing and mitigating the credit risk was proposed to be utilized to assess and mitigate money laundering, ML, FT, and fraud risks from the customers. Clear, and fraud risk from the customer. Okay, due diligence, that is proper checking of the customer, they record their ID proofs. Nature of due diligence for this purpose would be substantially different and it would encompass the entire customer base of the banks. As the Vienna Convention in 1988, FATF was formed for suggesting the measures for prevention of money laundering. Clear? So basically, in which convention? That is in Vienna Convention in 1988. Clear? Basically, what was formed? FATF. In 1990, I request to all of you kindly tell what is the full form of FATF in the comment section. All these questions you will directly find in your examination. Clear? Most of the banking is basically banks. Either it is to the private or it is to be the government or public sector undertaking. Clear? So they will insist their employees to do this examination. Clear? As a certificate. So in 1990, among the 40 recommendations of FATF, customer due diligence was one of the most important recommendations. In 2001, BCBS published a detailed guidance for the banks on the customer due diligence. Here in 2001, BCBS basically published the detailed guidance for the banks basically on the customer due diligence here. So what is the need of the KYC policy? So the obligation of the banks under PMLA are very onerous and have enterprise wide applicability. For effectively implementing the KYC or AML guidelines, it is important for the banks to develop the comprehensive internal guideline in this regard. RBI has therefore, clear further, that is RBI has therefore advised all the regulated entities and banks, clear, RBI has therefore advised all the regulated entities and the banks to frame the KYC policy, incorporating the guidelines issued wide master direction, know your customer direction 2016 and subsequent updates last up to May 2021. Clear all the guidelines, basically it is to be updated by the RBI regarding that. So the KYC policy basically serves as the framework for the bank within which its products and processes are knit from the perspective of KYC or AML requirements. Clear? Like even if you are going to process the loan, first of all, you have to check the symbol, all these things clear, KYC verification, Aadhaar, PAN, all these things from the respectively portal. And presently what the trend goes on, many of the numbers are basically involving in the cyber fraud. Clear? Even now banks are issuing the guidelines basically to check their number, clear, whether they are involved either in the past or presently involved in the cyber fraud or not. Clear? They are also verifying all these details, clear, that are also comes under these policies. So given the international impact of the KYC or AML, anti-money laundering measures adopted by the individual banks, RBI has directed that the KYC policy it is needed to be approved by the board of directors of the banks. Periodically review. As the countermeasures for AML, CFT are continually being reviewed and enhanced by the international agencies. So in view of these changes and also based on the incident of money laundering and terrorist financing in the country, the RBI also revises the regulatory guidelines. There are also amendments made to the PML Act and PML rules in order to align them, clear, in order to align them with the international guidelines and or observations made during FATF assessments, clear, during FATF assessments. Hence, the banks have been advised, clear, hence the bank have been advised to disseminate the changes, guidelines, etc. as and when these are notified, clear. Okay. Hence, the bank has been advised to disseminate the changes, guidelines, etc. as and when these are notified, and the bank's board must ensure to review their KYC policy at least once in a year. This is one of the question. Clear? Basically, what is the time to review their KYC policy? That is at least once in a year by incorporating all the changes pertaining to the regulatory guidelines or the legal aspects. Clear? Pertaining to the regulatory guidelines or the legal aspects here. So what are the elements of the KYC policy? Clear? Very, very important. Definitely you will get to have one question from that. So RBI has advised the following four key elements must be included in the KYC policy of the bank. CAP, that is customer acceptance policy, risk management, CIP, that is customer identification procedures, monitoring of the transactions. Okay. So what are the key elements? Clear? How many there are the key elements of the KYC policy? There are four key elements. First one, CAP, that is customer acceptance policy. Second one, that is risk management. CIP, that is customer identification procedures. D, that is monitoring of the transactions to be here. Okay. So this is the basically what overview of the KYC. Clear? Just we are discussing few points. In the next session, we will discuss in detail regarding that. Clear? For all the KYC sessions, KYC examination, institution will provide you all the important topics and MCQs regarding that. Clear? So thanks to all of you for joining this basic discussion.